Hi, everyone. Hi, this is Girish Rimali, and I lead the transition finance and transition risk research at the Oxford Sustainable Finance Group. And it's a pleasure to talk about a recent report on tracking the cost of capital for the energy sector. With that, let's put the presentation on, please. All right. So again, welcome to the webinar. And today we are going to talk about our recent report on energy transition risk and the cost of capital. And this report is by the Oxford Sustainable Finance Group. And I'm here with my colleagues, Xiaoyan Zhu and Christian Wilson, who will be covering part of the webinar. So let me just kind of start with, and what I'm going to do in the first few minutes is to give you a brief background before we get to the actual report so that you have the context behind this work. And the idea is that the cost of capital is a key lever in the real economy because it influences investment decisions and capital flows. Now, the reason the cost of capital is important is that a lot of the risk that's perceived for a project or for any kind of energy project or any kind of energy investment is driven by various factors, including the energy transition risk. So if the energy transition risk is embedded in the cost of capital, that could drive the net zero carbon transition that we all want to happen. And the idea of this research is to understand not only how the cost of capital is changing over time, but also how is that being influenced by the perception of transition risk. And on another complementary side is the kind of investigation into how the changing cost of capital is influencing investment decisions. And this is important to various actors, including policymakers, practitioners, and civil society. For example, for policymakers, it's important to understand what the stranded assets risk are due to changes in capital markets. It's also important for policymakers if the cost of capital is high for low carbon investment, where are these reductions needed? Cost of capital is also important for practitioners to have a visibility on to changing market sentiment and risk preferences so that they can inform their investment decisions. And finally, it's important to the civil society because changes in the cost of capital can provide some kind of evidence of impact and needed to push for changing policies and changing regulation. Next slide, please. And as I had mentioned in the beginning, that the cost of capital is very important for the net zero transition, and this slide demonstrates that. So this is a UK case study on looking at what's the cost of the energy transition required to get to net zero by 2050. And the left-hand graph shows different costs for different sectors, including capital expenditure and operational expenditure. And that the left-hand graph or left-hand chart is showing all these costs for a cost of capital of 1.5 percentage points. And whereas on the right-hand side, the same graph is shown for a cost of capital of 7.5%. And what you can see from this is that as the cost of capital goes from 1.5 percentage points to 7.5 percentage points, that will show an increase of 30% in the cost of getting to net zero by 2050 for the UK. So you can see as to why the cost of capital is important. And in the subsequent slides, I'll also talk a little bit about how cost of capital is impacting the actual delivered cost of different energy sources. Next slide, please. This slide talks in more detail as to how cost of capital is important for the net zero transition. And the primary reason behind this is that as we're looking for net zero transition, the idea is that low carbon technologies will replace high carbon technologies. And this is an example of the power sector where the idea is that wind, solar, and similar green technologies will replace power that's generated from coal as well as natural gas. And what you can see on the left-hand side is that if you look at a life cycle cost by different sources, the when we break down the life cycle costs across capital expenditure, which are upfront, versus operating expenditure, which are over time, over the lifetime of the project, for coal and natural gas, which are the fossil heavy sources, the most of the life cycle costs are in their operating costs, and some of it, the life cycle cost is in upfront cost. Whereas if we look at wind and solar, which are the kind of the primary low carbon sources that we're interested in, then the capital expenditure or the upfront costs are a significant percentage of the lifetime costs, varying somewhere between close to 80% to close to 90%. So this contrast actually really plays out as the cost of capital changes. You can see the life cycle costs when they are discounted to time zero and then converted to per unit of generation, a metric also called as levelized cost of electricity. Then you can see on the right hand side that as the cost of capital changes, the cost of the levelized cost of low carbon energy is much more sensitive. And this is sensitive to the cost of capital, which is on the x-axis. And this is exactly what plays out in the previous graph that I showed. Where changing the cost of capital by 6 percentage points increases the cost to get to net zero by 2050 for the UK by about 30%. And next slide, please. So having kind of demonstrated as to why cost of capital is important for net zero transitions, and primarily through its impact on the levelized cost or the per unit cost of delivering electricity or delivering any kind of clean energy service, then the idea is like, can we kind of track this cost of capital over time to see if the cost of capital is changing over time, and that's what Shayan and Christian are going to talk about. But as I said, we also want to understand what are the drivers of this cost of capital, and as well as how cost of capital drive investment decisions, and that's happening in parallel work. But the theory of change is that the cost of capital is driven by various kinds of risks. And it all starts as a risk premium on top of a risk-free rate. And the risk premium is built up of different kind of risk premium, including liquidity, country, as well as credit risk of a particular project. But then also now what we are starting to see is this climate-related risk, which is driven by our climate-related transition risk that we are talking about here, is driven by various factors such as policy changes, technology costs coming down quickly, or legal aspects as well as market and reputational concerns. So there are a lot of drivers of this climate-related transition risk, which could drive the cost of capital. So the first step is just tracking that cost of capital, but we are also, as I mentioned, there is ongoing work on understanding the drivers of cost of capital. And then on the other side, the theory of change is, and it was kind of clear from the net zero graph that I showed you, that if the cost of capital goes down for clean energy projects, that means the clean energy projects become more competitive. And not only they become more competitive in the marketplace and therefore get deployed in kind of higher numbers, but also it reduces the cost or the net cost of getting to net zero transition, and therefore kind of reducing or removing some of the barriers to net zero transition. So let's move forward to the next slide, please. As I started to mention that part of the theory of change is that we're going to track the cost of capital and the changing cost of capital, but also we want to understand how this energy transition risk or transition risk is starting to affect the cost of capital. And this transition risk, which as I had mentioned, is comprises of multiple factors. It's going to be seen through many different studies, including our work, is already starting to materialize. For example, in terms of policy, there is a risk for fossil-heavy assets that as policies become more supportive of low carbon investment, it'll be harder and harder to kind of invest in higher carbon fossil assets. Similarly, we can see that the technology costs for low carbon energy has been reducing at a very rapid pace. And most of the technology cost declines that we have seen for clean energy sources have been in fact higher than what was anticipated in the past, and we have seen learning rates of up to 40%, much higher than close to 20% that was originally envisaged. So this risk of technologies and green technologies becoming cheaper faster than envisaged is also a risk for fossil heavy assets. And finally, we are starting to see legal risk materialize where there's this issue of companies getting sued through legal lawsuits, and a lot of these lawsuits are happening against fossil heavy companies, and that legal risk starts to play into the increased costs for these companies, and therefore making the perception that these companies are riskier to invest in. And all of this kind of combines into increasing this whole notion of transition risk for fossil heavy assets, and reducing that for the green assets. And some of this we need to start seeing as we track the cost of capital. Next slide, please. All right, so I'm coming to kind of the end of my introductory remarks, and pretty soon I'll introduce my colleagues. But just to give you a sense of the kind of work happening here in our group, the Oxford Sustainable Finance Group, we had our first report in phase 1 in 2021, where we started this work and we tracked the cost of debt in the energy sector, and we used syndicated loan data. And we did find that cost of capital for clean energy sources had fallen. For example, solar and wind energy had fallen over the last decade, and it had also risen for fossil-heavy assets such as coal mining and coal-fired power generation. But we also found that the cost of capital for other fossil fuel-heavy sources like oil and gas has remained consistently stable. And in phase 2, which is the 23 report that we just published, we significantly expanded this analysis to not only track cost of capital by just the syndicated loan market and the debt, but also different analyses of different kind of debts, looking at accounting cost of debt, looking at bond transactions, etc. And we also expanded to incorporate the cost of capital for equity. And beyond that, beyond this expansion to different kind of analysis across different types of capital, and combining results from different types of analysis for each kind of capital, we also expanded our analysis significantly to different geographies. So we looked at North America, we looked at Europe, we also started looking at China, and there are also some partial results on developing countries. And we, as I mentioned, in phase 2, we have also started to look at the drivers of the cost of capital, as well as trying to look at how cost of capital is driving investment decisions. Today, we are here to mostly talk about the tracking of the cost of capital, but we are happy to talk to you about our other work as well as we go along. Next slide, please. All right, so with that, we are now with this kind of background and hopefully the context setting. Now we come to our 2023 report, which we just published. And I would like to hand it over to my colleague Xiaoyan Zhu, who is the lead on this project, who led the research on this project, to kind of get us going on this report. So over to you, Xiaoyan.
Thank you, Girish, for the introduction. Next slide, please. I will present the main findings of the AETRC report 2023. in the electric utility sectors. So in the 2023 ETRC report, so we expanded the scope of cost capital tracking to equities. No, previous slide, please. Okay. Corporate bonds and accounting data in electric utilities and energy production sectors globally. Specifically, we use accounting cost of debt, loan spread, bond spread, and the implied cost of equity to measure the cost of capital. We use three type of analysis to differentiate between low carbon and high carbon companies. So including the first one and the Refinitiv business classification, TRBC sector classification. We also use the level of carbon emission intensity, as well as the WEPP, the percentage of solar wind in a company's energy mix. So the reason why we expand the scope study to additional asset class, because we want to really understand whether a different type of investors respond to or perceive to energy transition risks differently, and also whether this difference vary across countries or regions. And also we use different type of method just to increase the robustness of our findings and the reliability of our findings as well. Okay. Next slide, please. Yeah, first we're looking at the data. So the data source we use for accounting cost of debt, we download the accounting data from Econ and WEPP, and we calculate the accounting cost of data by using the rate of interest paid to the total debt outstanding, including both bond and loans. And the advantages of using accounting cost of debt is that it encompasses both bond and loans, allowing a firm level time series to be constructed, which provides a more stable sample over time. We also use a secondary market bond spread as well, using the data, collecting data from TRIS. Because of data limitation, we only have this data covered in the US market. For the syndicated loan transaction, we're collecting data from DealScan. And for the implied cost for equity, we use the ex-ante equity valuation models to estimate the implied cost of equities. And the advantage of this approach is that it is forward-looking, so it could reflect the investors' expectation or perception regarding the future energy transaction risks. Next slide. Thank you. In terms of different type of analysis, so in the last year's report, we mainly use the Refinitiv business sector, TRBC sector analysis to identify renewable business activity versus fossil fuel business activity. However, in case that many large firms, they invest both the renewables and fossil fuels in their portfolios. So in this year, we also use the emission intensity analysis to differentiate the low carbon and high carbon firms. And so we use this is calculated by the rate of total Scope 1, Scope 2 emission by their total revenues. And also we use the percentage of the solar wind mix in the whole firm's portfolio to identify which firms has a high level of renewable power generation as well versus the level of fossil fuel energy mix. Next slide, please. Next slide, please. Yeah, so this slide shows the global trend of cost of debt and cost of equity in the electric utility sectors. The graph, the figure 1, shows the changes of cost of debt, and the figure 2 shows the changes in for cost of equity. Both figures based on the TRBC sector classifications. So in both graphs, the line shows the changes in the cost of capital, and the bar shows the number of firms assessed. As we can show that, as we can see that the light green shows the changes of the cost of debt or cost of equity for the renewable utilities, and the brown one shows the changes in the cost of capital for the fossil fuel utilities. And for both cost of debt, cost of equity, we can tell that globally renewable electric utilities have a lower cost of debt as well, a lower cost of equity than fossil fuel focused peers. That's a general trend. So for the cost of debt of renewable electricity is around about 6% compared to 67% for fossil fuel. And also if you look at the cost of equity, and we can tell that the utilities focused on renewables have a cost of equity lower than those of also having fossil fuels. Then we're looking at, in the next slide, we're looking at the changes in the cost of debt and the cost of equity in Europe. So figure 3 shows the changes in the accounting cost of debt, and figure 4 shows the changes in the cost of equity in Europe, both based on their level of emission intensities. The light green shows the top 50% companies, which means they are high emitter. They have a high level of carbon emission intensity, and the darker green line shows the bottom 50% firms, which they have a lower emission intensity. So both graphs suggest that the lower carbon electric utilities have a lower cost of debt as well as a lower cost of equity in Europe over the past 20 years. However, we can tell the slight different trend between cost of debt and cost of equity. So by 2020, the gap between the high and low emitters has fallen to 0.2% for cost of debt. However, it has grown to 5.4% for cost of equity. This changes in the trend could imply that, well, maybe the equity investors, they priced more transition risks in their investment decision. Next slide, please. We're also looking at the changes in the cost of debt and cost of equity, but based on the percentage of solar wind in a firm's portfolio. So the lighter green line shows the top 50% companies, which means they have a high level of solar wind in their portfolio. And the bottom 50% shows they have a lower level of renewables in their portfolio. And also the bar shows the average capacities in our sample firm. Anyway, so both graphs all shows that in Europe, low carbon electric utilities have a lower cost of capital than their higher carbon peers. And this finding is pretty much consistent with our previous slide, which is based on the carbon emission intensity analysis. Next slide, please. We're then looking at the changes in the cost of capital in North America. Figure 7 shows the accounting cost of debt, and figure 8 shows the changes in the cost of equity. Both analyses are based on the emission intensity. So both graphs also shows that in North America, the changes in the level of cost of debt is similar for the renewables electricity, similar or comparable to the level of fossil fuel, and the similar trend we found in cost of equity. So we could say that, oh, there's not much clear distinctions between low carbon and high carbon electricity in the cost of capital in the North American market. Next slide, please. So in the next slide, we're looking at also looking at comparing the cost of debt to cost of equity between renewables, fossil fuel, electric utilities, but based on the percentage of or level of the solar wind in the energy mix. So pretty much consistent that we can tell that there's not much separation, distinction between low carbon and high carbon electric utilities in North America. In the next slide, we're looking at the bond spread in the US market. So figure 11 shows the changes in the bond spread in the US market based on the emission intensity level. Figure 12 shows the changes in the bond spread based on percentage of solar wind in energy mix. And figure 13 also shows the changes in bond spread, but based on the low carbon energy mix. So the difference between low carbon and energy mix is that we also including, for example, the hydrogen in the as renewables. So not only solar and wind. If we compare, if you're looking at those three graphs, it is also quite obvious that the bond spread for low carbon and are comparable to high carbon electric utilities. This is in line with the cost of debt and cost of equity. So in the North America or in the US market, the result, the changing of like bond spread, the cost of debt, cost of equity, they all suggest that there's not much distinction between the low carbon and high carbon electric utilities. In the next slide, we're looking at how the changes of cost of capital in China looks like. So the figure 14 shows the accounting cost of debt. Figure 15 shows the changes in the cost of equity, and both analysis is based on the TIBC sector classification. In general, we can tell that in China, the low carbon electric utility have a slightly, higher, not slightly, pretty much higher cost of capital compared to high carbon pairs. And this result is kind of quite different with the trend in Europe and in the US. In the next slide, will also shows the changes in the cost of debt, cost of equity, but based on their level of solar wind in the firm's energy mix. Figure 16 shows the accounting cost of debt, and figure 17 shows the changes in the cost of equity. Anyway, here again, both graphs also indicate that in China, low carbon electric utilities have a higher cost of capital compared to higher carbon pairs. So for now, it's quite clear. We can see that the changes in the cost of capital, either cost of debt or cost of equity, so the renewables have a lower cost of capital in Europe, but higher in China, and the changes in the cost of capital between renewable or low carbon, high carbon is very comparable in the US market. So in the next slide, we will discuss some implications of our main findings in electric utilities. So first of all, obviously, we see there's a significant variations in this trend across regions. Second, based on our funding, we could probably say, well, policy matters in influencing the cost of capital. For example, in Europe, so low carbon electric utilities consistently have a lower cost of capital, including cost of debt, cost of equity. This could imply, well, maybe Europe has high level of environmental policy stringency. And in our second research paper, we have investigated, well, whether the environmental policy does actually play an important role in determining the changes in the cost of capital. And the result shows, yes, it does matters. And third, we also would like to highlight here that maybe other factors may be at play as well, except policy, maybe some firm level, for example, size, the firm level climate risks. They may also control or affect the changes in the cost of capital. However, in this report, we're mainly looking at the changes. We didn't control other factors, firm level factors especially. So this is for our findings in the electric utility sector. I will hand over to my colleague Kristen, who will report on our findings on the energy production sector.
Fantastic, thank you. If we could go to the next slide, please, that would be great. Yeah, so earlier we've been looking at electric utilities. Now we shift our focus towards energy production or the energy sector. And here we're looking at energy production from fossil fuels. So for example, coal mining and extraction, and then oil and gas. And we split oil and gas into kind of two high-level sectors. So we've got oil and gas production and oil and gas equipment and services. And within production, we have integrated oil and gas companies, so your oil and gas majors. Then we have exploration and production, refining and marketing. And then under equipment and services, we have your sort of midstream transportation, along with drilling and services and equipment. So we're going to be looking at this kind of a high-level industry grouping and then more granular subsector grouping. And then in addition to that, we have renewable energy. And that's distinct from the renewable energy companies we've been looking at within the context of electric utilities. So here we're thinking about renewable fuels companies, so for example, ethanol, biofuels, hydrogen, and then renewable energy equipment and services, by which we mean, for example, companies that may be providing technical services to, for example, wind farms, also solar power plants, or actually manufacturing that equipment itself. Can we go to the next slide, please? So in the interest of time, I'm going to probably focus on our global findings, but we find that these resonate kind of throughout regions as well. So what we're looking at here are these high-level sector groupings. And what we observe is that globally, both for the cost of debt and the cost of equity, we see that coal mining has the highest cost of capital in the energy sector. This requires some kind of BDIs because the colour schemes are slightly different, but you see on the left-hand side chart, black line is the highest, and on the right-hand side chart, this time green line is the highest for coal mining. And that's been the case since around 2016. So after the signing of the Paris Agreement, kind of a frame of reference. What we also see is this persistent gap between oil and gas production and oil and gas services, and that holds within both the cost of debt, kind of over the past decade, and more recently in the cost of equity, kind of emerging after 2016. And we sort of had a kind of like quite a sharp crash in the oil price from kind of 2014, 2016, and following that we see this kind of gap emerge between oil and gas production and oil and gas services. With regard to renewable fuels and technology, kind of unlike electric utilities, we don't see this kind of clear separation between low carbon and high carbon. So we actually see that the cost of debt and the cost of equity of renewable fuels and technology is above that of oil and gas services. But what we do see is in the past kind of 4 or 5 years, while fossil fuels have seen an increase in cost of capital, renewable fuels and technology haven't seen these sharp increases and kind of being level or slightly decreasing. So next of all, we kind of look to these high-level sectors, so coal, renewables, oil and gas. Next, we kind of look at oil and gas in a little bit more detail to try and figure out what's driving the separation between production and services. So if you go to the next slide, please. So here we see this quite stark difference, especially for the cost of debt, between exploration and production, so sort of your capital-intensive, risky upstream activities, and the rest of the oil and gas sector. So if we look at the cost of debt, we see this kind of quite significant gap at around 2% in 2021 between exploration and production. And while other subsectors have kind of seen this falling cost of capital over the past sort of 20 years or so, as we've seen kind of interest rates generally decline, exploration and production has remained stubbornly high and has actually increased in recent years, especially since 2016. We see a similar story in the cost of equity. It's a little bit more messy, but we do see in the past few years, again, exploration and production has had the highest cost of equity. And we've also seen very significant increases in refining as well. So we see that's high, but kind of that trend is a bit less clear. But what we do see there is, again, this kind of sharp increase across the board since 2016. I maybe do, if we could go to the next slide as well, I'll do Europe as well. So what we see here is, again, sort of consistent with global findings. We have this gap between oil and gas services and production with a higher cost of debt for oil and gas production. And we also see this on the cost of equity side as well, with kind of a sharp uptick in the cost of equity of oil and gas production in recent years, since kind of 2016. And then we also see on kind of, in both cases, a kind of a more stable to falling cost of equity. Yeah, but again, higher than oil and gas and not kind of significantly lower. Could we go to the next slide, please? Next slide. Thank you. Yeah, so if we break that down a little bit further, kind of within the oil and gas sector, we again see this clear separation between upstream exploration and production and the rest of the sector. You know, a gap of around 2%, which is quite a lot considering that kind of the next highest level. If you look at integrated oil and gas companies, they're around 6% of the cost of debt. Pure play exploration and production companies around 2% more. So it's quite a significant increase when you look at it as a cross section. And then, yeah, we also see this hold within cost of equity as well, where there's been a sharp uptick in the cost of equity of exploration and production since 2016. And so we see this kind of consistency with the global picture as well. Next, we'll look at North America in the next slide. So here again, on the left-hand side, we see this persistent gap between production and services, which has kind of expanded in recent years. We see this on the cost of debt on the left-hand side and the cost of equity on the right-hand side, where we also see the sharp uptick since 2016. So quite common themes across the regions. What we see interestingly here is this very volatile cost of debt for renewable energy or renewable fuels and technology. We don't have enough data to show this for the cost of equity. But what this is likely to be is this kind of clean tech bubble bursting around sort of 2012 in the wake of the financial crisis, which saw this kind of very large increase in the cost of debt. And this has kind of rolled over in recent years, has declined quite rapidly, and hopefully we'll see that continue going forward. Next slide, please. And then again, North America, we see on the left-hand side, this kind of high cost of debt for exploration and production, the highest kind of, if you look at the cross-section, and we see a significant increase in that in the past kind of 5 years since 2016. What we also see in North America, which we don't see in other regions, is this very sharp increase in oil and gas drilling as well. If you think kind of the big shale industry in the US, that's quite an interesting observation. And then on the cost of equity side, the picture is a little bit more convoluted, but we see again sharp increases in the past kind of 5 years. If we could skip ahead to the implication side, that would be fantastic. Cool, brilliant. So kind of we see two major findings here. One is renewable fuels and technology. Although their cost of capital is kind of coming down in the aggregate at the global level, it's not yet below fossil fuel alternatives. And so although it has lower transition risk, that does not appear to be compensating enough for other forms of investment risk, such as these kind of new, smaller, riskier technologies that may be emerging kind of the clean tech space. The second kind of main finding that holds across regions is we see this very persistent gap and increasing gap in many cases between upstream activities and the rest of the oil and gas sector. And kind of we would expect a higher cost of capital in general because this subsector is riskier, it's more capital intensive, more can go wrong. But it's interesting seeing this gap between them kind of grow in recent years. And this could reflect sort of investor caution about funding in new rounds of oil and gas expansion and further capex. And we've seen a lot of capital discipline from oil and gas companies recently. We think about their large dividends that they've been paying recently, rather than recycling that back into high capex. And kind of going forward, if we see this gap growing or persisting, this could constrain the ability of oil and gas companies to kind of invest in a lot of new development and new fossil fuel reserves going forward. And that constraining of production could play an important role within the energy transition, given the need to kind of curtail oil and gas, further oil and gas investment. So I'll stop there. Oh, and very quickly, if you go to the next slide. Yeah, I agree. Do you want to wrap up, actually?
Yeah. Can we go to the next slide, please? So, yeah. So thank you, Shayan and Christian, for going in detail on our research findings. And I just wanted to briefly give you an overview of what's been planned now and this year. So one of our outputs is kind of providing similar kind of tracking for and going beyond the electric utilities and energy production to other sectors and primarily industry and looking at cement, iron, and steel, and trying to see if there is some of these trends that we see are being observed there as well. As I had mentioned during my initial context setting, we also have two complementary streams of work in addition to the tracking of the cost of capital. One of the stream is looking at is climate transition risk is materializing, and is it starting to impact the cost of capital? And I see there's a question here that I can also pose to Shayan in a bit on that, and Shayan has been leading that work. We also have an ongoing piece of work on how the cost of capital is impacting firm level decision making, and I can invite Christian to give a brief overview of that research as well. But we're pretty excited that this work has been progressing in a pretty steady manner, and we'll have much more to talk about in the future. But with that, I think that's pretty much the end of our presentation. So let's go to Q&A. So I'm just looking at the questions that are being posed in the Q&A box, and let me start by asking a question, and I'm gonna try to distribute these questions to Shayan and Christian, and maybe take some of these myself. But the first question is for Christian, and the question is, could you please link recent windfall taxes on energy industry with the cost of capital of their net zero investment?
Yeah, sure. So I think if the windfall taxes had not come into play and oil and gas companies were able to return more of their earnings, kind of Finance 101 tell us, the ability to earn more would reduce your cost of capital over time, and that would hold kind of on the cost of equity side and the cost of debt side. I guess the challenge is that if the windfall taxes are introduced for kind of a very short-term change in markets as a result of the Russian invasion of Ukraine, for example, to what extent would investors kind of look through those short-term changes in market conditions and actually change their assessment of the long-term viability of oil and gas companies within the context of the energy transition, and whether that will substantially change their kind of cost of capital going forward, may not happen. And so that's something we'll probably look to tease out in kind of next year's report or in future reports where we have data for that. One thing that's worth kind of commenting on with regard to the point about net zero is that while kind of if the cost of capital was, for example, to increase because of these taxes, because of the huge earnings of oil and gas companies right now, the huge bump in dividends that are being paid, kind of extraordinary levels of capital being returned to shareholders, that kind of suggests that a higher cost of capital was not constraining their investment activity right now, whether that's in fossil fuels or net zero. But going forward, we may see a higher cost of capital reduce their ability to invest in net zero. And that's because if you think about oil and gas, generally high return, high risk, and that reflects generally quite high cost of capital that we see in oil and gas companies, as opposed to companies in the electric utility sector. If we see companies in the oil and gas sector try to pivot into kind of renewable energy, for example, where the returns are generally lower, if their cost of capital is going up while they're trying to pivot into these lower return sectors, you could see that constraining their ability to make those investments, because that would be basically reducing their returns while having a high cost of capital. And so that could cause problems for them in their abilities to make those investments in low carbon energy.
Thank you, Christian. And I think there was a related question around, could you please reflect on the recent collapse of banks and the risk in the banking sector and how it would affect the cost of capital?
Yeah, I guess any sort of credit contagion in the banking sector would lead to kind of an increase in the cost of capital, which would be a negative for companies and their ability to invest. In particular, if we think about kind of the slides that you presented earlier, Garesh, where we see that low carbon energy in particular is very sensitive to changes in the cost of capital compared to kind of high carbon power assets. I guess the flip side is if the crisis kind of becomes worse and that results in the Fed pausing their rate hikes, and then that's actually, I guess, a good thing for renewable energy if interest rates don't rise substantially higher from here. So I think we're yet to see how that plays out, to be honest. But I think it could go both ways.
All right, thank you. Let me ask a question to Shayan, and this is the question that is around what is the contribution to cost of capital from climate-related risk premium? how can we quantify that? And obviously, the question goes into more detail on can we apply the classical form of French modeling to this exercise? I will start by answering this question first, that there has been a lot of research that's been done outside our group by Patrick Bolton, etc., that look at the kind of the climate risk as being a factor, one of the factors, and its impact on the cost of capital for higher carbon companies versus low carbon company. And there's evidence, statistically significant evidence, that the cost of capital has been impacted for the equity, for public equities, by the kind of climate transition risk embedded into the carbon prices or kind of emissions that could result in higher costs for these companies if carbon taxes were to materialize in a significant way. But the reason I'm channeling this question to Shayan is that it helps us talk a little bit about the work that she has done on her kind of investigation of how the different drivers of cost of capital are starting to impact cost of capital. And in particular, she has looked at the role that policy plays. So Shayan, if you can come in and talk a little bit about the work you've done and the evidence that you have found.
Yeah, sure. So in a separate research paper, we investigate how environmental policy stringency actually can change the cost of debt, loan spread, and whether the changes of loan spread could also determine investment decisions. So we found that the environmental policy, including the carbon tax and carbon trading scheme, the national R&D expenditures on renewables, as well as the solar wind technology support instrument, can also increase the cost of debt for the fossil fuels. Meanwhile, it also decreased the cost of debt for renewables. And this, for renewables, and this increase or decrease in renewables could lead to more investment in those countries with, for example, high level of environmental stringency. However, we also found an interesting result that for supporting technology, solar wind supporting policy, even though there's the effect on the cost of debt for renewables is not significant. However, it also increased the investment in renewable electric utility as well, which also could probably indicate that the investors, they tend to invest in renewables if there's a high level of solar wind support policy in that country, as well as there's a high level of support like R&D expenditure, national support as well. Yeah, maybe I will answer the other question regarding if we control the size and some other factors. So
yeah, actually, Shayan, I think there are two questions together. Perhaps you can answer. One is the how do you control for size, and the second one is the how do you get a level of confidence in these results.
Yeah, sure. So, so in this report, we mainly actually just to show or reveal the changes of cost of capital across different energy sources. We didn't do further like regressions and on those, just to show, okay, that's the trend and the alarming trend in different countries. But however, in a separate study, for example, in the policy study, we control the other factor, for example, including the firm size, the loan size, the loan, other characteristics, and the firm level credit risks, and macro level economic development. So all those factors we controlled in our regression, but we still found that policy actually has a significant impact on the cost of capital and investment decisions. Yeah.
Okay. There's a kind of a question for perhaps both of you. We talk a lot about the cost of capital for North America and Europe and China, but what about cost of capital in developing countries? And do we have any results on that, and any thoughts on results for developing countries? So Shayan, do you want to take it first, and perhaps Christian, you can pitch in?
I think because of the data is not consistent over the past 20 years for the emerging country. But anyway, so I think we included the region, including Japan, Korea, Southeast Asia, African, Middle East, all those. The results are varied because of data limitation. When we're dividing the companies based on the different analysis or different category criteria, the limitation, the data point limitation is for some regions less than 5 or so. We didn't think that is a very reliable result. So I'm not sure. So maybe we need to further sort of using the type of analysis to enhance some findings based on the limited data. For example, maybe we use case studies for different region interviews as well.
All right, cool. There's a question on this result that the upstream oil and gas production and exploration, the cost of capital has gone up, and that's going to constrain the investment in upstream operations. But what about national oil companies? Because these national oil companies are unlikely to have such constraints. So Christian, I think that's a question for you.
Yeah, I think in general, I agree with the premise of the question. I think they are probably less constrained. But I would say a couple of things. One is that, in my understanding, and I could be wrong here, often these national oil companies partner with the international oil companies because they have sort of more expertise in engineering and other factors to kind of actually extract the oil that they own, and therefore there is a link between the two. And then the second thing I would say is that a number of the national oil companies raise a significant amount of capital from capital markets. So, for example, in a previous life, when I was working in emerging market debt, we would finance a lot of these national oil companies directly from through the bond markets, for example, in South America or in the Middle East. So there is a reliance on capital markets still. And if you have the pricing of climate risk, for example, or other risks in the oil and gas sector, that should, affect their ability to operate. But I guess having that link to the state probably makes that less crucial than it would for a private sector firm.
All right. Well, thank you so much, Christian and Shayan. And this has been a very interesting and exciting experience. And I thank you all for joining this webinar. We've kind of gotten to the end of the hour. So unfortunately, I see a lot more questions. Please do feel free to contact us directly. And with these questions, this recording of this webinar will also be available. And I see a lot of requests for slide deck as well. So we're happy to share that as well. So with that, I again wanted to thank the attendees as well as Shayan and Christian. And thank you again, and hope to see you soon. Bye for now.